The initial claims numbers, you could perceive them as falling, if we're looking back at a year ago till now. But when you're looking at the 4 week average, we're coming off of a low here that we had coming out of the end of March. And so it's been, end of March, we had the 4 week moving average of initial claims tick higher on April 4th, tick higher a second time here going into April 11th, and then a third print higher. And it's always the third print higher that's always really interesting. So on the 4 week average of initial claims, we're in an uptrend. 2 data points, you could make a case. Don't make a trend. 3 do. And that's going to be interesting considering that we're sitting essentially at the top of a range up here. Now, the other thing that's probably the most, I would say that this is probably the most important thing to understand in 2026, is that this year is typically the fourth year in a credit cycle when you've had 3 years of very dramatic dollar weakness. You have the dollar start to ramp up, and we have all of these, I guess, overlapping forces that are really putting a kind of a lid on the stock market. One is the dollar strength cycle. The other is the Fed rate cut lag. And we typically have, if you study back into the 1940s, a 22.2% decline after the Fed starts cutting interest rates. There's an 11% rally, 22.2% decline. The war in Iran is not getting any better. It's not resolving. In fact, it's just getting pushed out into the future. It's not resolving, and that is the issue. And then, of course, we have the AI deflationary shock. And the most important, though, is that this dollar series of longs, these are daily charts. Look at where the targets are above us. That's a long ways going into the autumn of 2026. And we have just confirmed our rally away from our support level. So we have the double bottom, we have the long setups that we ran into earlier this week. And right now, we're going straight up in extensions. And straight up in extensions is bad for the broad markets in this current environment. Why? Because we are in a deep negative correlation. The negative correlation here is a -0.8 on the 30-day, -0.9. And so when the dollar was falling back down into its support levels for the last 2.5, 3 weeks in this incredible dollar downtrend, it created think of wind and sails of a ship for the indices. They were ripping. And as we came out of the beginning of this week, somebody threw an anchor over the edge, over the side. And the anchor is scraping along the seafloor. It doesn't matter how big of a gust of wind that you have, we're not going anywhere. That's the problem. And what this extension long level represents is where that anchor is digging into the seafloor. I don't know how else this analogy is one that I think makes the most sense, when we're thinking about a way to explain this. So we have all of those forces in the market, and the one thing that was really driving the indices to rip into new all-time highs, well, that's over. Currently, that's over. Now, there is a question. This stream continues at eMoneyAddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.